You might pay less federal income tax in 2026 just for having a side hustle, but you'll almost certainly still owe more in self-employment taxes. The One Big Beautiful Bill rewrote the playbook. Higher standard deductions, changed bracket thresholds, a much larger SALT cap, and a huge estate exemption. But what does that actually mean for someone who works a W-2 job and runs a side gig? Stick around because I'll show you who wins, who loses, and 3 concrete calculators you can use to estimate your 2026 hit, plus the moves you should be making now to avoid a nasty surprise next spring. In the next 16 minutes, you'll get a practical, step-by-step breakdown of how the 2026 tax landscape after the One Big Beautiful Bill affects W-2 employees who also run side hustles. We'll cover the new standard deductions, the 2026 tax brackets, the bigger SALT cap, yes, it's roughly $40,400 for 2026, and the bumped estate exemption. I'll give you 3 concrete ballpark math examples: low, middle, and high income, and a quarterly checklist you can use to avoid underpayment penalties. Quick heads up, this narration is for educational purposes only and does not constitute tax, legal, or financial advice. State rules vary and tax law changes, so check the IRS and your state tax authority or consult a licensed pro for specifics. Now let's jump in. First, the headline items that actually matter to side hustlers in 2026. The standard deduction jumped to $16,100 for single filers, $32,200 for married filing jointly, and $24,150 for head of household. The IRS also published inflation-adjusted bracket thresholds for 2026, same marginal rates as before, but the thresholds moved up, reducing bracket creep. Here's where it gets interesting. The bill raised the federal limit on state and local tax deductions, the SALT cap, from the old $10,000 to roughly $40,400 for 2026. That changes the itemized versus standard deduction calculus for people in high-tax states. Also, the estate and gift exemption is $15 million for 2026, huge for wealth transfer planning, but less relevant to most side hustlers. Self-employment tax, though, is unchanged. You still pay Social Security and Medicare on side hustle profits, about 15.3% on the SE base, and half of that is an above-the-line deduction, but it doesn't eliminate the SE tax. Quick question to hold in mind. What's worth more, the new standard deduction or itemizing because of SALT? We'll test that in the examples. Don't assume a bigger standard deduction means you can stop tracking receipts. That's a trap I see every year. Let's be clear about the taxonomy. Federal taxable income equals gross income minus above-the-line adjustments like half of SE tax or retirement contributions in some cases, minus either the standard deduction or itemized deductions. For a W-2 employee who tax on side hustle profits, the new higher standard deduction directly lowers federal taxable income, but it doesn't reduce self-employment tax. So here's a mini cliffhanger. Do you benefit more from increasing retirement contributions or simply claiming the larger standard deduction? Answer: it depends on whether you itemize and your marginal bracket. If you don't itemize and your side hustle profits push you into a higher bracket, contributing pre-tax to a 401 or traditional IRA lowers both taxable income and the income subject to marginal tax rates, and in many cases can help control your estimated tax or withholding needs. Example pivot. If you earn $35,000 W-2 and make $7,000 net freelancing, the new standard deduction will wipe out a lot of the income tax on the side hustle. But the SE tax on that $7,000 still exists, roughly 15.3% of about 92.35% of the net profit, which is about $990. So lower income tax, but still nearly $1,000 in payroll taxes. Pattern interrupt? Want the math for low, middle, and high earners? Real numbers are coming up. Before the bill, many people in high-tax states were stuck paying a lot in state tax but could only deduct $10,000 on their federal return, which often made the standard deduction look better. The SALT change changes that incentive. If your collection of SALT, mortgage interest, charitable gifts, and other itemized deductions exceeds the new standard deduction, you should itemize. Now, the nuance. The SALT cap is roughly $40,400 in 2026, not unlimited. So if your state and local taxes are $60,000, you can deduct up to $40,400 federally, which may still make itemizing valuable. But states may react differently, and some will decouple and maintain their own treatment of SALT on the state return. So you might gain on the federal side, but still feel the hit at the state level. How do you decide? Quick checklist to run mentally. Add up SALT, up to the cap, mortgage interest, charitable donations, and any medical expenses above the threshold, then compare that total to the standard deduction for your filing status. If the itemized total is larger, itemize. If not, take the standard deduction and keep receipts anyway. You never know if a year-end change or a large charitable gift will flip the result. Even if you plan to take the standard deduction, tracking donations and mortgage interest is still useful because you might switch mid-year or in high-income years. No matter what else changed, self-employment tax didn't get a makeover. If your side hustle nets profits, expect roughly 15.3% SE tax on the relevant portion of earnings. The IRS uses 92.35% of net profit to compute the SE base. Half of the SE tax is an above-the-line deduction when calculating adjusted gross income, which helps with certain credits and phase-outs, but it does not reduce the SE tax itself. Concrete guidance. For side hustles where SE tax is the big bite, retirement contributions that reduce AGI are powerful. Contributions to a solo 401 or SEP IRA reduce taxable income and may reduce your AGI, which improves credits and AGI-based thresholds. But contributions don't reduce the SE tax base unless you lower net profit first through business expenses, so track business expenses carefully. Mini cliffhanger. Should you elect S-Corp status to cut self-employment tax? Sometimes. We'll talk about thresholds and when it makes sense in the hiring a pro section. Now time for numbers. These ballpark examples show the interplay of standard deduction, SE tax, SALT, and bracket movement. Common assumptions. Single filer, standard deduction, $16,100, SE tax, 15.3% on 92.35% of net profit, and brackets roughly 10% up to about $12,400, 12% up to $50,400, 22% up to $105,700, and so on. No itemized deductions unless stated. Example A. A low-income side hustler, W-2 wages $30,000 plus net side profit $3,000. SE base equals 92.35% of $3,000, about $2,770. SE tax at 15.3% is about $424. Half the SE tax is a deduction of about $212. AGI becomes about $32,788. After the standard deduction of $16,100, taxable income is about $16,688. Federal income tax on that is roughly $1,754. Add SE tax $424, and total federal plus SE is about $2,178. Compare that to no side hustle, where tax would be about $1,390. Incremental tax from the side hustle is about $788. That $788 is not pure loss. Remember, you earned $3,000 net. After federal income tax and SE tax, you still walk away with roughly $2,212. And business deductions, credits, or state rules can shift that number. Example B. Middle income in a high SALT state.